Good morning and welcome to this fourth Risk and Compliance Reimagined webcast of Accenture. My name is Sara Douwes and I will be facilitating today's panel discussion, which will be focused around the use of machine learning and data analytics for KYC and transaction monitoring models. I hope it will become a very interactive discussion whereby you can post your questions in the chat box so I can raise them with my panel members. With me today are three very experienced speakers who I will briefly introduce before we kick off. Starting with Daniël. Daniël is Head of Innovation and Design of Detecting Financial Crime with ABN AMRO. Daniël has been working for ABN AMRO for over 11 years in many different roles. Over the last 3 years, he's been focusing on the innovation and design within detecting financial crime, whereby he's responsible for the bank-wide client due diligence design and processes. His team develops monitoring models in order to detect suspicious behavior and cooperates with companies to strengthen the network against financial crime. Cyprian Smits is Head of Data Science Department of Rabobank, which develops solutions to support the digital transformation of Rabobank, mainly focusing on KYC analytics, financial analytics, and transactions as risk. Before joining Rabobank in 2017, Cyprian worked for the tax authorities for over 6 years in several different roles, among others as Chief Analytics Officer. Last but not least, I have the pleasure of introducing my colleague Edwin van der Ouderaa. He's a Senior Managing Director working for Accenture in many different roles since 1995. Edwin has led the financial services digital and analytics practice globally for 10 years. He's currently responsible for our global customer sales and service practice across all industry. He holds a PhD in data and analytics and was the chairman of the liquidity sessions at the creation of Basel III by the Basel Committee because of his research he has been doing in risk models. As Edwin is based in Belgium, we will have to switch between screens, so please bear with us in case of any slight delays. To start with the first question of today, I hope that Edwin will elaborate on what is happening within machine learning and what is the role it plays within the KYC and transaction monitoring domain. Edwin, over to you.
Thanks, Sara, and it's really great to be with you guys, Daniël and Cyprian. Hope next time we can be physically together. I hope there's not an echo with the sound. Is it okay on your side? Okay, good. Sara, as we were preparing, you said you were going to ask me what machine learning is. And it occurred to me it's about 40 years ago that I did this for the first time. So I thought, let me look up on Wikipedia what it says, what machine learning actually really is. It says it's a set of systems of mathematical models that take input data or training data, as we call it, and that without further intervention, so to speak, they create models so that you can actually make a selection between different type of data, and you can predict certain outputs based on these things. So neural networks and other techniques are used for that. I think machine learning models has both a strength and a weakness in a sense, isn't it? Because you don't have to kind of calculate everything yourself, and they will do it. These models will do it for you. So that's quite easy, and that's why they're very popular, and we use them. But you need to put training data in there, and that's in a sense at the same time then the weakness, because then you are, if you put the wrong data in it, then you may not necessarily get all the outcomes that you would like, and you may not necessarily know what's going to come out. But I'm sure we'll talk about that more in the future in the next questions. But it also shows why it's being used so much for things like KYC and transaction monitoring, because anything where you have tons and tons of data and tons of patterns that are coming through of that data, you need very rich models by which you can understand what's going on and distinguish between these different patterns so that you can make decisions on which ones are the right ones and the wrong ones and what you need to do with them. So I think in a short nutshell, that's kind of what this machine learning is about.
Then over to you guys. So I know that you've been working with KYC and TM models on like a daily basis. And when we were pre-discussing, we already went into depth about the challenges that we see. But what for a role do you see that has been developed over these years in KYC and TM models? Let's start with Daniël.
Yes, of course. I think I can spend a few more words about that. I think the role of machine learning is increasing. And why it's increasing, I think it has to do with the expectations of society, expectations of supervised, expectations from a regulatory perspective. And if you combine that, it's about knowing your customer. And knowing your customer, every client we see and every behavior around the client has, in fact, there's always a question, why is the client doing this? Why is the client doing that? That has to do with how the structure is built up, the behavior, the counterparties of the client. And it's the question, what do you need to know from this perspective? And in many cases, you can derive that from data. It's a combination of elements. And what I think is for the monitoring purposes, for client monitoring, for transaction monitoring, the old-fashioned way of monitoring is the rule-based one. It's one-dimensional. And a one-dimensional way of monitoring means that you will have a lot of false positives because you can explain what happens if you combine it with other data and other elements you know from the client. And machine learning is able to combine that. And if you combine those elements, you are able to answer questions that you do not have to ask to our clients and do not spend your manual assessment time on it. And I think it has also a link to the privacy part here, because we focus on the clients from which we cannot derive the answers on the why questions from the data perspective. I think that's more the other side of machine learning here. I think the big advantage here that you can answer the why questions partly, and so focus on the most effective way of monitoring.
To improve the true positives.
To improve the true positives and to focus on the patterns, and the clients you really want to focus on, and to ask questions to the clients, what happens here, and is this maybe suspicious or in the Netherlands unusual behavior?
I fully agree. And how do you look at that, Cyprian?
Well, maybe rule-based is maybe old-fashioned is maybe not the correct word. Actually, it's more policy-driven than risk-driven or data-driven. And policy-driven means that you think that something is suspicious or should be monitored, so you make a rule out of it. Let's follow cash, with a certain threshold. And policy-driven means that it starts with your own opinion about what's risky and what's not. If you use machine learning technique, it's much more look at the data and let the data tell the story about what's risky and what's not. So that's the learning part of machine learning, to understand the behavior. Daniël just explained, I think, quite thoroughly. Look at the behavior and let mathematics decide where the risky and non-risky threshold lies. And I think that's the difference between rule-based and machine learning, policy-driven, and more or less data-driven or risk-driven. So both perspectives are important, because policy-driven, you need it because you have regulations. If a regulator says you have to follow cash, then you better make a rule and follow cash. That's the easy part. But the machine learning is to improve your false positive ratios, if you like, or to see suspicious behavior, what's not in the regulations yet, but what's important to see, or to tune the thresholds of the policy-driven rule-based engines you all have. So I think both worlds are important. They play their own role, and you have to combine them for a successful operation. So what you see now in what I think is more or less, what can you say, should you go rule-based or machine learning? No, you have to do both in a good combination.
And when you talk about these models, what type of models do you prefer to use in this domain?
Well, do you want the long or the short answer?
Well, I would like to hear from all three of you. So.
Well, okay, I start off. I think first, where do you use models in the complete flow of transaction monitoring or KYC? Of course, it's on the detection part. That's the, if you like, the most sexy part, to finding fraud, for instance. But also in optimization, in case handling, you can use machine learning too. Which case should be handled by which auditor, on which time, and with what kind of information. It's more recommendation engine type of modeling, if you like. So there are several parts in the complete flow where you can use modern techniques of machine learning. But another thing is in detection, of course, you need quite fancy stuff, if you like, but if it's, I just heard Edwin say about neural networks. We don't use neural networks yet because they are still hard to explain why they exactly say yes or no. Computer says yes, computer says no. And then you, of course, have troubles in model validation. You probably have also troubles in explaining to regulators or even to court or to clients why you find something suspicious, because the only answer you could give is the computer says, and that's not enough. So the real, what do you call it, neural net type of modeling we don't use in KYC. Random forest and gradient boosting type of techniques are quite common. I think that's probably the same with AMRO. That's the main road, if you like.
Yeah, I think I can add to that indeed, that what you usually do from a functional perspective is looking to a peer group and clients that are the outliers of the peer group. And then you see the clustering algorithms, the isolation forest, that kind of algorithms are used most often, I think. And usually also in combination. So you can have, for example, 3 algorithms, and the outcome of the algorithms, you can combine it in a so-called ensemble, and that can give more insights in the real outliers here, because every algorithm has its weaknesses, of course, and you can combine algorithms to avoid the real weaknesses in the end here, and that's I think one of the things. So if you ask the question, it's more the cluster algorithms and the isolation forest, and it also depends on how you do set up your conceptual framework here. I agree with you about the rule-based and supervised model combinations, because you have historical information, and that is what you usually use as an input from your risk analysis to your transaction monitoring and client monitoring. That's the rule-based part, and also the supervised part, because you train on historical data. And you're able to combine those. You can have a kind of probability of suspicious activity from a supervised model. And if you combine that, you can set your risk appetite. Below a certain threshold, it's maybe not worth to investigate. And above that threshold, it is worth to investigate, with some outliers, with rule-based outside borders here. But next to that, to avoid any tunnel vision, you need to have a kind of anomaly detection. And that's usually done by the isolation forests. And you will learn from that. So one of the things you just said, Cyprian, is about we learn from experts. We learn from thematical analysis, from information from other sources, external sources, but also from our own models. Because the result of anomaly detection can be the input of your risk appetite. And it is your new history. So your supervised models will not have the tunnel vision. Well, always a little bit, and maybe even more than a little bit, but it depends on what you do in your anomaly detection and the majority of alerts there.
Good, thank you. I saw you nodding, Edwin. Do you want to add to Daniël?
Yeah. I think there's several great things that were said. First of all, I think there's not a single mathematical algorithm or model that does everything that you need. So you will always need to use a whole set of these techniques for different purposes and then see how you fit them together. That I think is the first thing. Then there's the thing about the isolation forest or other techniques used to find the anomalies. And I think we're going to come back to that later on, I suppose, but the patterns of stuff that happens in real life are constantly shifting. And so we train our models and our processes so that we detect everything that's going on. And then at some point we feel like we have good performance, because based on all the cases that we know and all the patterns that we know, we believe we can detect most of them, and we keep our false positives down as much as possible. But then over time, things shift and new situations come up, new ways in which people or organizations try and hide themselves or misrepresent themselves, or transactions patterns are being constructed to avoid sanctions and other compliance regulation. And so you need to kind of start finding them. And the problem is you don't know what you don't know with these things. So where are they? Because it's a bit of a cat and mouse game, or a poacher hunter, or what do you call it, forest guard game. And they always say the poachers are the best guardians, I suppose, because they're constantly trying to outsmart the people with their algorithms and find the weaknesses. So you need always methods on top of the normal flow of your transactions, where your billings are flowing through, to kind of spot what the poachers are doing right now. And for that, typically you need these special tools to find these outliers. So we should talk a bit more about that, I suppose, later on in the call. But I find, of course, the most exciting part of the whole work on transaction monitoring.
Thank you, Edwin. And already talking about poachers at 9:17 in the morning. So maybe just a question from the audience. Are you expecting, and maybe a question then to start off with Cyprian, that KYC and TM will be fully automated in the future, or will there still be the necessity for people to do a lot of the manual work that is currently going on?
It's a good question. Straight answer is, I don't think it will be fully automated. And I hope it will not be fully automated, because it's how do you call this, a vulnerable process. You know, you want to have a man in the loop somewhere to make the right decisions, because looking at suspicious behavior, if you like, is quite invasive for people and for organizations. So having people in the loop is very important. But you could optimize that you have people of men in the loop in a place where you can add really value. And what we now see is that we let people do the work computers can do. And then you need massive amounts, of course, and that's not good for the bank, but it's also not good for people either, you know. So optimization will be at hand, that's one. But we will have, in the end, always people responsible and in the loop. That's the second thing. But I also think that the complexity still rises. We see that in the last few years. So the transaction monitoring and KYC domain will be more and more complex. More complex means you have more and more information at hand, coming from other sources, inside, outside the bank, between banks. You get probably more possibilities to use all kinds of governmental data to fulfill your role. So that makes it complex, also in data protection, but also in the ethic part of modeling. So I see a lot of complexity rising, and it means also that fully automated is not very likely to happen, if you ask me.
Daniel, do you agree?
Yeah, I fully agree with that. I think the traditional TM and KYC will disappear somewhat. I think it will be more combined in a client integrity assessment approach, in which we combine all the data elements here, and the complexity will rise here. And if you combine those insights, more complexity, more data points, there will be a lot of automation and there will be a lot of intelligence in the system. But in the end, it's the combination of human and machine. And I think the machines can support the investigations more and more. That means that we can take better decisions, we have better insights, we have a better view of the client or the network around the client. And I think that is more the future than replacing human staff by robotics or automation, other automation.
I also fully agree. I think that for compliance professionals, the life will become much more interesting if you can really focus on true positives instead of doing the alert handing all these false negatives, false positives. Another question. Can you explain how you prevent unwanted bias in the models used, which is, of course, a very interesting question. And just to make sure that everybody has a chance to speak, so Edwin, over to you to start off with.
Okay. Thank you very much, Sara. Yeah, unwanted bias is a very, very tricky problem. And the simple answer would be let's just be conscious about the fact that we have that problem, and let's then introduce test sets that go through a whole spectrum of potential biases, and let's put them in the system, and then let's make sure that let's say the transactions or the people or the companies that are being pushed through the system are all treated equally, even if they come from certain environments where we would have expected bias. I think that's kind of the obvious answer. What I see is that it's a bit to the previous question. It's because that's one of the things, by the way, that creates exception handling or wrong or false positives, and therefore prevents full straight-through processing. I think the reality is a lot more complicated than that, and is subjective to a large extent, and is dependent on our view of the world of what is good and what is bad, and that view is not very clear. So I worked on one of the largest AML and transaction monitoring facilities in the world, one of the biggest banks in the world globally. I mean, with just tens and hundreds of millions of transactions per day across the whole world. And so all walks of life are represented in there, all kinds of combinations of patterns of people, and their family structures and their relationships, and the same with companies, and then the sort of things that they do with each other. And then it becomes sometimes really hard to understand what's really going on and where the boundaries between what we would see as good or bad in the context of our risk profile, or in the context of what the regulators in various countries, by the way, are asking us, which is often not consistent. And so it's a bit of a, what was I going to say, a morass. It's a bit of a marshland where you can sink in with your feet, because it's not, it's not totally objective. And so I find that there are often sets of patterns, even if we're in absolute good faith, okay, that we do not see or can detect or understand that they actually even can exist. I'm actually been, if I can give an anecdote, I've been the subject of that myself. So I thought it was quite funny. Well, it wasn't funny at the time, but so my wife is British Indian. So she lives in London. I'm from Belgium. I'm a white guy, as you can see. I mean, we never use that word, but okay, these days people say that. Okay, so we live in both countries. We come from very ethnic different environments. She is a vlogger. I pay for her ads. We were in Vietnam, and I was paying with my credit cards, my Belgian credit card, out of Vietnam for the things that she was doing in America, in San Francisco, but with our account from London. Okay, you're starting to see how complicated this is getting. All right, plus there were several currencies involved. And then the bank and the credit company thought that this must definitely be a fraud. And the explanation we got afterwards was, it can never be that you guys are married and that you are living the way you are doing, and especially not out of Vietnam. And we got all kinds of weird explanations about these things. But all my credit cards were blocked as we were in Vietnam, so it was a bit painful. But I'm just saying, there are obviously all kinds of patterns we need to find that are, or biases we need to avoid. But even there, I suppose they were all in good faith, but there was a bias there, no? But it's very subtle, no, sometimes. So it's That's why I'm thinking this is not an easy problem. We definitely have to keep working on it and keep testing against it. But a bit like the fact that the patterns of the bad behavior are constantly moving, I think as society shifts in its behaviors globally, biases also shift, and we also need to be conscious of that. It's not a simple, classic, old-style bias of old days. You know, that's a long answer, but I think that makes it very tricky.
Thank you, Edwin. And I guess that you guys are tackling the same issues on a day-to-day basis. I don't know where we have such great examples as that Edwin has about his own personal experience, but maybe Daniël, can you?
Yes, it's kind of personal examples. I do not have them, to be honest. But I think that one of the things to add here is, do you have a bias and fairness framework in place? That's the more fact-based part within the financial services departments, I think. And bias and fairness, you could first investigate your data inputs. So what is the data you use for which purpose? Then you can test whether there's a difference in the outcome based on the data elements. You're not allowed to test everything. I think that's still a pity. I think we should change to that you're also allowed to test whether there's a difference in the more sensitive data fields of clients, to avoid or at least to reduce or limit the bias in a certain model. There will always be any kind of bias here, but I think you can give the insights of the bias in your control framework, and you can test it and you can validate that. And I think that are important steps to show what you've done to avoid it. And I think it's not only the machine learning models that do include any bias and fairness issues probably, but it was already there if we used decision trees, etc. So it's not a new risk, but the difference here is that it's a more complex risk compared to the more classical models and setups.
You agree, Cyprian?
Yes, partly. And I think, well, first, what you said is that you should have a framework in place to do bias and unwanted bias or fairness testing in the model building setup you have. And I think all banks have, we have, and you probably do have the same. So you should have it in place, that's for sure. But then the complexity starts, and exactly what you say. If you don't have any information, for instance, about political background, then you could also be testing your models if it's biased or not, because you don't have the information in the first place. And if, for instance, it's religion, then you're not allowed to have it, the data fields to test. So you don't have the data. It can be unwanted bias, but you have not the ability to test if that's at hand or not. And the moment you have it at hand, then basically you're not allowed because of privacy regulations. But if you say we do it for the good cause to see if our models are biased or not, then of course someone could say you have the information, you probably use it. So it's a complex mechanism, or what do you know about your data? What do you want to know? What kind of data do you want to have inside the bank to use in your models? So that's the complex area. And another thing is it's unwanted bias. I always think, okay, what's the wanted part of bias? But I don't know. It's always unwanted, I guess. But of course, you could take care of what kind of variables do you use in your models. It should be limited in the first place. It should be very well investigated if it's the minimum set you really need. So get rid of, for instance, postal codes in models, for instance, because we know it's very likely that some bias will be at hand when you use this kind of information in models, so better get rid of it. And if you use it, be very careful. Or age groups is also difficult. And so are a lot of typical variables you have in your set, which you know they are likely to cause some sort of bias. And we try to not use them. And if we are using them, be very careful and test intensively. That's the only thing you could do. And last, and I think you both mentioned, it will shift. What we see today as unwanted will be different from what is 5 years ago or from 5 years from now, will be monitored or being seen as unwanted. And your models stay there for a long time. So that's also quite difficult.
Yes, and absolutely.
Sara, if I could add something, because as you guys were talking, it occurred to me there was something that I wanted to say about that. So fully agree with those points. And I think, Cyprian, what you touched upon is a data paradox that we see with a lot of this stuff. That is that for some of these things, in order to make the models better or to check things like bias and so on, you would need data, which by having the data in itself is actually a problem. So how do you solve that? And I think in a number of the cases, what we've done is just to make sure that we don't use potentially contentious data points in our mainstream models, like you said, but we have some test sets that are very well controlled so that we can sample things to double check. Otherwise, we don't know that, but then we can do that with let's say fake data, so not about real people and so on. But at the same time, for example, postal codes, while they could be extremely biased, that's definitely true. At the same time, we also need them when we, in AML, we try and find rings, so gangs of people that are literally doing rings, which often in these tests show up as rings, literally. So there was sometimes, so geolocation can be very important. But the other thing I wanted to talk about, because what I was giving myself as an explanation earlier was relatively qualitatively. From a more quantitative point, and maybe we'll come back to that also later on in another context, is the use of explainability models. So models that explain other models, like line and chop, those types of models. What we've done quite successfully is use those models on top of other deep learning models. So this gets really, really complicated. And like you said earlier on, it's not always clear what are these models doing. Well, that's why we have the explainability models that actually model what the models are doing. So we know exactly what's going on, and we know what the effect is of every parameter that's going in. And we see the spectrum for every parameter, how every parameter, every type of data point affects the outcome in positive or minus, like a sensitivity analysis. And when we then put test data in those models for bias, then with the explainability models, we can see how the bias data, if we put bias data in it, how much that affects the outcomes of the models in positive or minus. And with that, we can actually quantify them. So it's not just a qualitative thing, but we can quantify the bias to some extent, at least enough so we can understand how big the problem is, all right? Because by definition, we are training our models that they converge to a solution based on many, many inputs. So we are forcing them to come to a conclusion. But then we're saying, yeah, but there are certain of these conclusions we don't like. Yeah, but because of bias, but that in a sense, as we said, is half subjective. But with at least with the explainability models, we can quantify what that is. And then we can say within which bounds we think the tolerance is okay, because it doesn't affect our real decisions we're going to take in our business processes, so that we are not taking the wrong decisions from an ethical perspective versus the population that we're looking at. All right, so I just wanted to give you that so we can use those models in a quantitative way for that. And that I think is very helpful.
Just to get back to the question. Not yet known, which is a very interesting one, and exactly something we would like to have a silver bullet. But we're not yet there, I think. But Daniël, let's kick off.
It's the easy one for you, Daniël.
Yeah. I think in first instance, the unknown unknowns are called unknown unknowns. So that's for a reason. Next to that, I think what you can do is to trying to find new insights, and you can do that by using the expert opinions and make that in a data analysis, visualize and just try what you see. So if you read something in articles and you think, well, if you combine this with that, etc., let's try that. If it might end up in a suspicious activity. On the other side, you have also the anomaly models. I just talked about that, and anomaly models are algorithms, of course, that do kind of outlier detection without the labels, so without the historical training data.
Unsupervised.
And the unsupervised ones. And I think the outcome of, as well as unsupervised, as the expert opinions in thematical investigations, can give some insights in the unknown unknowns. Maybe you find more. And I think if I look into what we are doing, it is true. You find new patterns, so you find new phenomena. And that can be used in your supervised models, in your risk appetite, in your rule-based settings, etc. But how do you find all the phenomena? Yeah, well, that's a kind of art of the work, I think, to at least try to find as much as we can.
I fully agree. And you, Cyprian, how do you do that?
Well, it's also the nice part, isn't it? Because in transaction monitoring, you couldn't take any random sampling, for instance, because the amounts, the volumes are just too big, you know. So it's no use in just random sampling. And I think there's where the puzzle is starting, isn't it? How do you do anomaly detection? So smart sampling, if you like, and could you free up capacity to assess those cases, to give really flags, wrong or good, you know, this kind of stuff. And I know that all the banks, also with ABN AMRO and also with Rabo, we do this kind of investigations. I think it's important, and we already do that not only banks, but I think in the financial industry whatsoever, that you interchange this kind of investigations and results. We have quite a vivid exchange of IDEs, and also I think it's every month or so we have some meetups with all data scientists coming together and explaining what they are doing, because there's no competition, if you like, in being compliant on KYC. And that's a good thing. So it means that we find something, we offer it to other banks and vice versa. And that's, I think, the best way to go forward. And then, of course, you will never find the last phenomena, because there will be new ones. But for an example, let's say we do something about cryptocurrencies, for instance, and we find a loophole in which it's very handy to detect something. I think we will interchange that immediately with other banks, like, okay, this is working for us, could you use it also? That would be the right way forward. You never be fast enough to come up and detect new fraudulent patterns, probably. They will pop up, and there will be new ones.
Good. Edwin, anything you want to add from your experience?
Yeah, so it's very similar to what we also do in insurance with claims handling. So there's also a lot of fraud that we need to detect. It's the same thing. And also their insurance companies often exchange information with each other on the types of new fraud that arrive. And I think that is probably the best weapon, is the fact that all the banks, or at least a large section of the trusted banks, can exchange that information with each other, because it's very sensitive information. So we need top level security people to be the ones that exchange that information. So I think that's, for me, it's like a network of, back to my analogy of forest guards, a network of forest guards that talk to each other regularly to understand the new poacher techniques. But to what Daniël and Cyprian were saying, there's always a time lag of a few days, weeks or months before we detect certain things. A method that we have used a lot, and it's a generalization of the anomaly detection thing, is cluster analysis, so unsupervised cluster analysis. We can now do the cluster analysis on hundreds and hundreds of variables, and hundreds of millions of data points. In the old days, the calculations would be too long, but now we have enough processing power to do that on vast amounts of data, and we can do it in a continuous manner. So I like these unsupervised methods, because there is even less likelihood of putting bias somehow in the model, even mathematically, because you just let the stuff run and it just automatically clusters. So it creates in an n-dimensional space, 500 dimensions or something, it creates these clouds of data points. And when you see tiny little clouds appear, I mean, when I say see, we can't physically see that with our eyes as human beings, but you can get the software to go and scan that space. And if you see little clusters, little bubbles, as I always call them, appear that were not there before, that means there's a pattern there of combination of all these variables, often variables that you didn't know that were connected with each other, because that's part of the new pattern of the new way in which the poachers are doing their thing. But you see that appear, and it becomes statistically significant. Well, there must be something going on. And so to me, that's often the trick, to go and then look at what that new pattern is and then investigate that. And then often then that's an unknown that we find at some point. So to me, that's a typical technique that we would use. So,
are not black and white. Therefore, the models are not trained on confirmed truths, rather human judgment, as we know. Will that not be enlarged in the models itself? Who wants to take this one?
I think that the models are usually trained on, let's first start. You want to have the most accurate models in time. That means that you have to decide what is do you train your models on the recent SAR filings or the most historical ones, of which you probably know somewhat more. And I think that if you need to have enough SAR filings to have a reliable model here. So that means there's a trade-off in which what do you include, what do you exclude here. And I think it's good to focus on the more actual ones. That means that you might not know what is the end result here. So SAR filing is indeed probably not, in the end, it seems to be a false positive in the end of the chain. It might be relevant. And then I come back to the first part where it's about how do you derive the information? So answer the why question for a client. Why is the client doing something? And sometimes it's also valuable to answer that question, the why question, although it's a false positive, because it's an outlier. So I think it's still relevant to focus on what we call internal SAR filings. So you have a number of suspicious or unusual activity reports, and creating your models out of that. And if there's more data available, you can probably backtest it against the more historical information further on in the chain in a later moment. So I have the preference to focus on the more accurate, actual, recent suspicious activity, although we know that it might end up in a false positive from the FIU perspective.
Okay, good to know. And you, Cyprian, do you take the same approach?
We do take the same approach, and I think to add a little bit on it, what you also see in time, your risk appetite, but also regulations change. So the further back you go, the less it reflects what you think now, but the further back you go, the better you know what's really at hand at the case. So that's, I think, the optimum you try to find out.
That's the trade-off.
And this trade-off is complex. Another thing is that we only see a part of the customer journey, if you like. Let's imagine there's a customer who is fraudulent in the end. It starts as a new client without having any history. And then probably you get something like hiding your identity or changing things in which identity issues are playing a role, changing names, changing places, whatever, changing accounts. Put it on the name of your wife or your children and back and forth. So it's certain behavior before there's a fraudulent pattern, and there's a lot of stuff going on. But we don't know because there's no filing, there's no alert or whatever. So sometimes it's interesting to try to film it back, if you like, to the point where it really starts, and to study what was the behavior down there. And I think that's exactly what you mean. Look at the behavior of the client and what he really intends to come up with the patterns. So it's not an easy answer in what is the best thing to do. It's a lot of finding the optimum, but also understand that if you go further back, you have another type of information. And if you go shorter at the current moment, then it's probably more reflecting your risk appetite, So know what you're doing is important, and understanding the complete customer journey. I call it a customer journey, when in the end it's a customer journey, I guess. What understanding what's really happening and make really different models in every step, if you like.
And that, Edwin, also relates to your Vietnam example, isn't it?
Yeah, exactly.
Probably is.
And I can relate to a lot of the things that you guys were talking about. We've seen a lot of examples of the poachers, let's say, creating identities of people and companies, but that were actually genuine at first, and they let them do transactions that are genuine transactions. And then very slowly they start to shift the patterns. Okay, and then they hope that they can stay under the radar screen because they hope that the banks will have thought that they were just normal, okay, bona fide people and companies, and then they start subtly to change the transactions that are happening, and then so it often takes a while before you find those because you think everything was okay. So I think that's a good example of that. The fraudulent ones don't necessarily come in with a big bang to start with, but they try to stay under the radar screen. But it made me also think of a related aspect, which is about the false negatives. In fact, so we always talk about the false positives because we don't want to, and the word positive and negative in a sense is inverse versus the human intuition in this case, of course. So we always say we don't want the false positives because we don't want to stop the transactions of good people that are just doing a normal transaction. But actually, all the research shows that a large part of the fraud actually goes undetected. Okay. And that a lot of what should have been SARS actually never make it to that level. So what are the false negatives? Huh? So you need to also try and find those. Now, one of the methods that we've used with one of the big banks is to not just try and find all the bad patterns, but to also have a catalog of good patterns. Now, the catalog of patterns, of course, is orders of magnitude bigger because that's just life. That's just what people do and companies do in terms of all of their transactions. And there's a lot of those and many, many different. So you can't really exhaust that, but you can create, we were able to create, especially now with all the processing power we have, huge libraries of, let's call it positive filtering of everything that should have been normal transactions. Now, I don't think my Vietnam transaction would have appeared as a normal positive transaction, a good transaction, because it's a bit of an outlier. But at least it can help to understand the patterns of what's going on. That should normally be going on, so that you can at least take a lot of the good apples out before you focus on the rest of the apples, in which there will then be bad apples. So that's a technique that we've used. And the final point I will make on that, to Cyprian's point, is there is also a sort of a time paradox here, because the more we look at historical data, in a sense, the richer we can be in modeling and detecting everything. Because we know, well, we believe we know what was good and bad in the past, although it's not totally true, but okay, that's what we believe. But the problem is that things are shifting all the time. So I see a lot of examples where it's almost a form of overfitting on the past, but the reality of today and tomorrow is not that same of the last 5 to 10 years. And so we are actually making models that are really good for 10 years ago, but they're not good for tomorrow. And so that means that you will always be limited in how much good data you can actually use for the future. because the older the data, the more it's actually not reliable anymore to understand situations of the future. So it's a bit of a, we're a bit of a catch-22 situation there, in that paradox. And that, I think, is always, we have to live dangerously on the edge in a certain sense as we try and model all of these things. But that makes it also a very exciting field, I must say.
Thank you, Edwin. Well, maybe that's a good step towards data quality, because there's a question, and I think Cyprian would love to talk about this. Cyprian, please know we have 10 minutes left. What is the role of data quality management in the total setup?
I really, every modeling or whatever approach you choose, the data quality is key. It starts all with right data and good data quality and data quality management, that you know the quality of your data. Even if it's bad, if you know it's bad, that's also information. And what you see is a shift not only inside the banks, but also in regulations towards data quality and data quality management. That's a good thing, because we all know that if the data is coming in is of good quality, then you have a good chance also to make good models, basically. So this shift is a good thing, but it's also complex, because data quality, and of course historically, you couldn't improve very easy the data of 5 or 10 years ago. It's just there. So it's how do you call it? All kind of system changes we had in the past is still causing troubles in understanding the data. Is it a technical change or is it behavioral change, what we see? And this kind of issues are all over the place. And that's normal, because we use data out of, what do you call this, transactional and client data to make models for fraud detection and customer due diligence, and it wasn't administrated in the first place to do this kind of jobs with it 10 years later. So the data was not collected and being managed in a way that you could ensure to make good KYC models, if you like. So this is also a paradox in time, and I know Edwin likes this kind of stuff. And the third thing is that you see that we have more data coming from outside to in, more external data, interchange data. Now I guess that there will be more governmental data in the future. I don't know for sure, but I think it will be going that direction, I hope. But it's also complex, because making joins and linkages in those kind of sources is very complex. You have no idea how to link all kinds of sources in a right picture of one client in time. So data quality is massively important, and I'm very happy that there's a lot of attention from regulators, but also inside banks and from outside.
Thank you very much. Daniël, go ahead.
Yeah, maybe to add one thing on it. What is data quality, in fact?
We don't have another hour.
Oh, indeed. Just one thing out of it. For example, the industry code. Take that as an example.
Yeah.
What is the value of the industry code? Because it's possible to register your company with every kind of industry codes, or to add industry codes to it. What is the value of that data? It's not a data quality in the sense that it is not available. It is also that it's not. Yeah, we can validate it partly, but is it reflecting the business activities of our clients? Yeah. I think in a lot of cases the answer might be no. And I think that's one of the examples. If you talk about data quality, it is complete. It's you have another source having the same information here, etc., etc. But what is exactly the value?
It's all green.
It's all green.
And still it's red.
And still it might end up in something else. So that's also an interesting one here for data quality. Where do you model on, and what is the assumption behind here? And I think that's also a challenge in modeling, and especially if you look into peer groups, outlier detection, etc. Are we putting the client in the right bucket here?
Good, and I fully agree with you, because there is no check from an outside authority on those type of codes.
No, it
nothing
isn't.
at all. I know, for instance, Company House is also dealing with that a lot in the UK. Edwin, and I know that you've been working with data also for decades. So how did you solve this one, or did you?
Oh, yeah.
Now, please, can we stay here for a while? Yeah, because this is just too vast a topic. But I agree. There is one of the problems with data quality is that some of it is subjective and changes on the context. So it's not an absolutely fixed concept. Now, there's also a practical data quality that is more rational. That is the fact that there is the wrong data in fields or missing data. And so I think the systems need to be robust enough to be able to deal with these types of things. So and there's two types of systems. There's the systems where we are doing pattern detection and the learning itself. And there we have to make sure that the models are robust enough and there's enough data in general so that things average out, so to speak. So that and that the models are not too sensitive to bad data or missing data. And there are a number of techniques for that. So that is definitely important, because then at least you can make sure that the models are trained in a way where they still converge to the right conclusions, even though originally there was a lot of noise on the original data sets. I think that's very important. And then you come to the individual transactions. And then that to me is more of a straight-through processing problem. Okay, so that is, data comes in, there is data points missing, there's things that are wrong in the data, for all kinds of practical reasons. That means that the transaction or the KYC verification is not going to go through, or it's going to pop up an exception. And so that's where, to the original point at the beginning of the session, you need to getting to 100% straight-through processing is not possible. That's one of the reasons. And so there you need to be able to investigate and quickly check whether it's a data problem or it's a pattern problem, in the sense that there may be something strange going on here. Okay, and then you need to be able to recover that when you believe it's a data problem. And then, of course, you always need to think, well, maybe they are trying to pretend it's a data problem, of course, which is also a pattern. But then that is something that you can build into the process, to ask for extra data or to verify data or to enrich data, so that the bad data gets compensated, and then hopefully things can flow through the rest of the straight-through process again. So comparing exceptions because of bad data in the transactions versus a suspicious pattern, to me, that's then the key practically, where it shows up that you have bad data coming through.
Sounds like a lot of work.
It is.
So, and that's all we're doing.
Keeps us busy.
Exactly. We have 2 minutes left. I have a couple of questions which I wasn't able to raise with the audience, with my panel. But given time, I think we have to finish. I do invite everybody who has remaining questions that want them to be answered, please do reach out. I'm happy to send an email to my panel members to ask them for their input. For now, I would like to thank you very much for joining, giving your honest input on the challenges in relation to modeling within banks in the Netherlands. And Edwin, thank you so much for dialing in from Belgium. And I hope that I will see you maybe in a next webinar around this topic, because I don't think we finished talking about this amazing topic. Thank you, everybody. Thank you for joining, and hope to see you at the next Risk and Compliance Reimagined webcast.
Thanks, guys. Nice working with you guys. Talk soon. Ciao.